All right, so let's start with the financial management introduction, the presentation, right? So first, we'll talk about the meaning of financial management, and that is the planning, organizing, directing, and controlling of financial activities of an enterprise, right? So we say planning, you do the planning of the financial activities, you organize it, and then to direct it. Especially among wealthy people, this is pretty much the scene, all right? So imagine John Harvard, if you're familiar with John Harvard. John Harvard is the one that donated the large sum of money to Harvard University. And even though he has died, um, you know, his plan, the organizing, the directing of his finances, still being controlled by his will and testament. So that is a prime example of a management of finance, right? And that's for one estate of John Harvard. And for John Harvard is a millionaire. Certain enterprises of also do their financial management. Okay, it also concerns with procurement, okay, allocation and control of financial resources. It refers to the efficient and effective management of money. It used to, it sounds good on paper, but in reality, it's really hard to do. How do you know that you are doing it efficiently or effectively? The management of money. You don't know because you can only know that after the return of the funds, right? But that sounds good, right? You want to be efficient and effective in the management of money. How do you do that? That's the whole goal of financial management. Okay. Some definition, according to Guthman and Dougal, financial management is the activity concerned with planning, raising, controlling, and administering of funds used in the business. Financial management is that area of business management devoted to the judicious use of capital and a careful selection of the source of capital in order to enable the spending unit to move in the direction of reaching the goals. So when you say financial management, it's the activity that makes you plan, raise, control, and administer the funds that you use in the business. Of course, maybe you've heard about the weighted allocated cost of capital. The cost of capital serves as even as the hurdle rate of the business in doing the business, right? So you know that for sure when you compute for the cost of capital, because you know more or less the usage of money in your business. Like for example, the cost of capital will consider the loans that you have done, that you have made to the bank. If the total asset, for example, of the company is 50% liability, so that means 50% liability takes into consideration the interest being paid for that money. So if it's a $1 billion business, so that's $500 million, that earns interest. If the interest earned is 10%, then if you will compute it, because the liability is 50% of the capital, that means your cost of capital will be 5%. Now, if you want to put that as a hurdle rate, then 5% is the hurdle rate. If the shareholder wants to earn 10%, and then there's 10% of the bank's interest rate being charged, then that means that your allocated cost of capital would be 10%. That's the average of the shareholders' need and the need of the bank. And since it's 50%, then it's the same. So we'll talk about that more as we proceed. Don't worry if you have not gotten what I'm saying, because it's better when you look at it in Excel. Okay. Next, again, some definition from Massey. Financial management is the operational activity of a business that is responsible for obtaining, so obtaining is part, and effectively utilizing the funds necessary for efficient operations. Again, pretty theoretical in nature, and it seems to be okay, and until you're the one doing the financial managing, okay, of the business. So uh in summary, with all the definitions that's being placed here, you have your money and you know how to obtain the money. That's financial management as well. But you have the money, you want to build a plant or a factory. If you don't have the money, then you secure funds, right? So how do I do the securing of the funds? How do I get the money to put into the new plant? First of all, you ask yourself, do you really need the factory? And of course, it's the board resolution that says, yes, we need it. So we need money to finance it. So how do we get the money? First of all, you can consider loan, borrowing from the bank or issuing some shares if you are a listed company, or, selling some shares to private individuals. Selling some shares of the private individuals or issuing shares publicly, that would dilute the capital. If you're the owner of the company, maybe you would not want that. Or maybe you would choose the liabilities from the bank, securing loan from the bank as something that's better. But if you consider the high interest, for example, during that time, if the interest is at 10 or 11%, and maybe you will say, oh no, we don't want to pay interest that large, especially this kind of economy, then maybe we'll just issue some shares to the public, and then try to gamble on that. When the price gets lower, then we buy back the shares. Those are things that you consider in the financial management. That's just obtaining the funds, right? Effectively utilizing the funds. Okay, so what if when you try to get the money, you get the money, but then the plant does not start, the factory does not start on time. All right, so it takes you, for example, 6 months to do it or 1 year to do it. So what would you do with the money that you borrowed already? So where do you invest it in order for it not to be, zero bearing interest, and it's just there, accumulating dust and paying interest, right? So where you put it is again financial management. Okay, so much for that, the definition. Let's now focus on the next slide, which is, in the business dictionary, financial management is the planning, directing, monitoring, organizing, and controlling of the monetary resources of an organization. Yeah, pretty much straightforward, right? So here are the scope and the elements: investment decision, that's capital budgeting. Okay, where do I invest? Okay, capital budgeting. Financial decision, the type of source, the period, the cost and returns of the financing. If you want to borrow money, where do you get it? What's the period? Is it long term? Is it 1 year payable? Is it 3 years? Is it 5 years? What about the cost? What's the interest like? What's the hurdle rate? What is the return, right? The dividend decision. Okay, dividend decision is also considered as part of financial management. How much do I pay back to our shareholders from their retained profits? Okay, so this is financial management. We have three kinds of decision: the investment one, capital budgeting, working capital management, financial decisions, the cost of capital, structure, capital structure decisions. Capital structure is what's the structure of our capital like? What's the allocated cost of capital? What's the structure like? How many percent should be our debt levels? What about the leveraging of our finance, of our capital, right? How about the dividend decisions? What are dividend policy? How much is retained? Do we ever even pay dividends? Or do we wait for 5 years before, is it computed on a per project basis? When the project is finished or consummated, then that's the time we compute for the dividend, and we return only 10%. Those are policies. How much of the earnings is retained, right? So those are financial dividend decisions. So the objectives is to ensure regular and adequate supply of funds, of course, the cash it's almost moot in academic. You have to have cash. The funds should be there. We have to ensure, second, adequate returns to the shareholders, because the shareholders are the ones investing in the money. Of course, if you are the shareholders, if you are the shareholder, like for me, I'm more of understanding it from the perspective of the owner. I am the owner. Usually, I don't place that as number two. I place that at the end, because you don't talk about returns first. Maybe you would think about, first of all, yes, the adequate and supply of funds. Of course, you should have enough liquidity to get you by. Ensure optimum funds utilization, not even that. Ensure safety of investment, should be invested in safe ventures so that adequate return can be achieved. That's even extra money, right? To plan a sound capital structure, sound and fair composition of capital balance, debt and equity, that is even considered to be an afterthought. You know, I think it's more of fund utilization first in this case, right? And then safety of investment funds would be next, close next. And then capital structure would be more or less an afterthought, because even before doing the financing decisions and dividend decisions, that is already in your mind. It is already planned ahead. Especially as owner, you should have that in your thinking ahead of time, right? If not, then you will have a problem. And also, you have to get by. For example, for me, especially because I'm a business owner, of course you have to pay your obligations first. That's something that you cannot, uh, you cannot not do. You cannot not do. You have to do it, right? Pay your employees. That's financial management, but it's not here, because this is pretty much a sound corporation, a corporation that is doing well already, right? It does not take into consideration what about in a pandemic? What do you do with your funds? You have to pay your obligations first. You have to pay the government, pay the taxes. That's part, because if not, you will incur penalty, right? So that's for most of your concerns. And then you pay your employees, pay your suppliers. You don't talk about the returns to the shareholders immediately, because sometimes you have to grapple with the losses. Okay, but these are theoretical. In the books you will see this, but in reality, that's not really what's going on, right? So basic objectives of financial management would be profit maximization. Yes, in the ultimate sense, it's how you want it to be, wealth maximization. But it's for me, again, as a business owner, it's really an afterthought. You don't think about that, especially when you're just starting your business. That is part of a nice to have. You have to survive first. The day-to-day activities, you are able to pay your obligations, your employees, and then whatever is left, you have to maximize it. Right? Yeah. So for me, operational objective would be number one, even timely availability of requisite finance, most effective utilization of finance, safety of investment, growth of the enterprise. Again, growth of the enterprise would be an afterthought. You will know that as soon as you know that the operation is already in place. When you're earning a lot of money, then that's when profit maximization comes in, wealth maximization, growth of the enterprise. Even if it's just a small sari-sari store, or if it's just a small uh, what do you call this? Carinderia. Do I do I open up a new branch? If it's a pharmaceutical company, do I open a new botica, a new branch? Is that something that I can do? Yes, you can do, maybe operationally. But what do you do if you are the one controlling both? You're the ones managing both. What do you do? Do you go from one place in the morning and then close in the evening on the other side, or do you do it remotely? You put trusted people there. How do you do it? So operationally, it's really the case. And the financial part is again, a result of operational efficiency. Their social objectives, timely payment of interest. For me, that's number one. Payment of reasonable dividends. No, not really. It comes in later. Timely payment of wages. That's even, that's way above. Fair settlements of suppliers. Of course, you have to pay your suppliers first. Not the reasonable dividends. Timely payment of taxes. Maximizing relations with financiers. That's first even. Social objectives. This is really more of operational and you know this is the one that keeps you from it keeps you afloat, because if not, then you will get sued and your business will go under immediately. Research objective, researching into new and better sources of finances. So maybe again, theoretically it looks good, these objectives of financial management, but in reality, do you really need that? First of all, you have to consider that your business is like always on a crisis mode, especially in the beginning. All right. So what do? You manage your liquidity in such a way as you pay the wages, pay the government taxes, pay the suppliers, and the interest if you have incurred, loans, if you have gotten loans from the banks. Those are the most important things that you have to do, and then maintain operational efficiency, and then try to find out, okay, how much am I making? Do I raise the prices, right? So those are operational decisions, but it forms part of your management of finance, right? Because if you can't survive that way, what do you do next? Do you source a new sources of funds, or do you add in capital? Yeah, those are the things. The functions, we have estimation of capital requirements. You estimate whether the capital requirements is enough. Number two, the determination of capital composition. Well, this is whether do I need to loan, do I need to apply for long-term debt or short-term debt? What is the equity analysis? What is my short-term obligation like? Those are important things to do, especially when you do your cash flow analysis. Choice of sources of funds. Yes, this is the one that I was telling you a while ago. Do I get the funds from shares, additional shares maybe, loans, from the banks, from other institutions? What about deposit? How about bonds? Do I issue bonds? If you are allowed to issue that, then maybe that's a good consideration. How do you invest your funds? How do you allocate the funds into profitable ventures? So, for example, you've said, okay, 10% of extra cash liquidity we invest. Where do you invest? Is it foreign currency? Is it time deposits? Is it bonds, for the government bonds? Or is it mutual funds, right? Or do you invest in other businesses? Okay, disposal of surplus. If there's a surplus, what do? Do you retain the profit, or do you pay out dividends? If you pay out dividends, how much do you do that for? Okay, then management of cash, which is the cash flow analysis, and then the financial controls, which is control of finances. So these are this is the diagram for the functions of financial management. Estimation of required capital, capital structure, select the sources of funds, allocate and control of funds, distribution of profits or surplus, and then monitoring of financial activities. So why is it important? It helps organization in financial planning. It's important because we know whether we're still okay. Okay, it assists organization in the planning and acquisition of funds. Where do I get my funds? Yeah, so that's part of financial management. Helps organization in effectively utilizing and allocating the funds received or acquired. This is important. I there used to be a time when starting a business was for me hard. I always tell myself, when I was young, 20, 22 years old, I said to myself, it's hard being not being rich, because if you don't have a lot of money, then you can't do your business, you can't do business. But then that framework of mind, that frame of mind, I used to think that way, right, when I was younger. That changed when slowly I accumulated the cash. For example, I took out a loan in BPI for 500,000 in 2008, 2009 or something like that. And then suddenly I'm gripped with fear. I have all the money, but I don't know what to do. I know already that I'm going to start a business, and now I'm starting to doubt myself. I said, do I really do this? Or do I just invest it in the stock market because I know that it's going to grow, right? So, it's really hard if you don't have financial planning and financial management, because acquisition of funds sometimes is easier, right? But the cost of the capital that you have now gotten, because those are not free, you pay interest for that. So you cannot just lay it down, bury it under the ground. No, you cannot, right? You cannot just put it in the savings deposit because you're just being paid 0.5% interest, whereas you're paying the bank for 8%, right? So, in order for you to be able to plan effectively the utilization allocation of funds, then you should have financial management. It assists, number four, it assists organizations in making critical financial decisions. Critical financial decisions would be sometimes even selling certain portions of the company, just like what Ayala did with Pure Foods, sold to San Miguel, uh or was it the other way around? Yeah, so I think Ayala sold the Pure Foods division. Diversification. Do I do diversification? Do I sell my 1% in the Bank of Commerce, just like what San Miguel did when they wanted to finance their Tiplex project? So what did they do? They think to themselves, okay, what do I do? I need funds. The decision was, okay, sell our 1% share in the Bank of Commerce. That didn't materialize. The ones who supposed to buy the 1% did not, uh, you know, uh, did not follow through with the promise of doing it. So they ended up still owning the 1%. So what did they do? They sold bonds at 7-8%. When that was a time when it was really hard, and San Miguel for a time was even removed from the PSE index, the composite index. But then, after some time, San Miguel is San Miguel, so they're able to make it, and slowly the projects fall into place, and that's why we have a very diversified San Miguel Corporation, a huge corporation, one of the most admired corporation in the Philippines. So uh, that's what we that's what we are talking about when we say you make critical financial decisions, because that is a financial decision. Do I sell my 1% of Bank of Commerce? That's a hard decision. Another thing that happened as a critical financial decision was when John Gokongwei Summit. This is when John Gokongwei was still alive. When he sold the Digital to Smart. The Digital is the one that owns the Sun Telecom, right? So Smart ended up owning Sun and Smart. PLDT owns Sun and Smart. And what happened to the John Gokongwei Summit? They own part of PLDT, right? So it's a stock swap. You don't get the cash, but now GJ Summit becomes a shareholder of PLDT, which is, a critical financial decision. Do you do that? Do you the stock swap, or do you just get the money? That is also what happened to Edgardo Sia. Edgardo Sia is the nephew of Tony Tan Cakchong of Jollibee. All right. So Edgardo Sia was doing the Mang Inasal. He's the owner of that. He has 100 branches already, and would almost at the brink of listing in the stock market. Of course, Tony Tan Cakchong said, okay, if he does that, then we can't buy Mang Inasal anymore because it will become expensive. So what did he do? Okay, we will buy Mang Inasal, in exchange for shares that we will start a new company called Double Dragon. So this is what happened. And for some of the money that was left to Edgardo Sia, I think he started his own Chick Boy, but Chick Boy did not prosper. I don't know if you have that in your place. There used to be one in our place, but it's no longer there. I don't know. Maybe it's not as successful as Mang Inasal. Okay, those are critical decisions. Do you get the money or do you do stock swap? Okay, so that you become an owner of the company. The importance also helps in improving the profitability of the organization. Again, this is an afterthought. You know this after the fact. You don't plan it. You want to improve profitability, but it does not happen immediately, right? Maybe it happens if you know that the return should be such and such, but you don't really know it in the beginning, right? So I disagree with the importance here. Increases the overall value of the firms. Yes, it increases the overall value of the firm and organization, especially in a stock swap, in a merger. Those are of from pure importance. Economic stability, provide economic stability. How do you do that? Because, for example, if you are incurred a lot of financial obligations, and then what do you do? Maybe you would take out a loan against your house and then pay everything, pay your debt. Okay, so you end up paying lesser interest. You pay all your bigger interest bearing loans. You still have a loan, still equal, but you end up paying less and less every month until you reach economic stability. So, those are financial management decisions. Encourages employees to save money, which help them in, I don't know, maybe not that well. This is not something that's part of the financial management for organization. Maybe for individual people, yes. Okay, standards for cooperatives. You know what? Cooperatives are also doing this, right? So let's start first with cooperatives. First of all, is stability, liquidity. This liquidity talks about the deposit liabilities. The liquidity is the cash of the company, or in this case, cooperative. Quick asset ratio, current liabilities, the ability of the company to pay the current liabilities using the quick assets. Solvency is the protection of the company, or in this case the cooperative, for members of the savings and share capital contribution in the event of liquidation of the assets and liabilities. How solvent you are. So usually looks at the obligation. Institutional capital, level of institutional capital to absorb potential losses. In the case of companies, this is just the net shareholders equity, right? Capital adequacy rate, the sufficiency of the capital to cover the risk asset. So the capital versus the debt, right? Turnover ratio, asset turnover, the same as companies, right? So asset turnover, how efficiently the company uses the asset to generate revenue. So it may be return on assets, turnover ratio of the asset. Receivable turnover, the accounts receivable turnover, the number of times the AR are collected within the reporting period. Now, this is important for cooperatives. For companies that are involved in lending or financial institution, this is also important. How many times are you able to collect your receivable? How many times? Loan receivable turnover, the number of times loans receivable are collected within the reporting period, especially if they are paying, amortization. Okay, there's also service receivable turnover. So service charges. Administrative efficiency, the cost of efficiently managing the assets of the company. Okay, sometimes we call that efficiency of management efficiency. Cost of borrowing rate, the efficiency of borrowing in financing its operation. What is the cost of the borrowing? Cost of borrowing may be in terms of interest rate, and for example, the rate of interest for certain loans is 10%, and you manage to lower it down to 7 or 8%, then that would be an efficient way to borrow to finance your operations. There are ways to do that, especially when you have a good relationship with the bank. Cost per volume of business is really a metric of operations rather than finance. But yes, it's also part of the volume of business. Like, okay, how many for if you are doing selling of retail, so for every 1 million sales, how much capital are you able to use, or because sometimes you loan, you extend loan to businesses, right? Or sometimes you yourself, the company, borrows money, and that is why you have to know the volume of business and how much is the business, the cost of the volume of the business. Okay. So extent of volume measures the ability to use the assets to generate the business. Again, it can be done by return on assets and all that. So for cooperatives, there is a growth of members' contribution. In banks, you look at it from the perspective of the deposit liabilities, right? Delinquency rate, the risk of default of the portfolio. For banks, it's the non-performing assets. What's the rate of non-performing? You do the accounts receivable, the aging of receivables, and then towards the end, there's the debt level that's being charged against your expense, the allowance for bad debts. Then that's your non-performing asset, non-performing loans, right? So NPL is something that the banks are also reporting to Bangko Sentral. So delinquency rate is the one that's appropriate for cooperatives. But for businesses also like that, you just make use of the normal, aging of receivables. Adequacy of provisioning, the APLL, well, that's really for cooperative. Yeah, for past due and all that. Profitability, well, we said that. Return on asset, return on equity, maybe not profitability, because return on asset is more efficiency. Return on member share, in the case of normal companies, this is return on equity. Return on net surplus, well, it's because the cooperative generate surplus funds, so so they have like that. But for ordinary organizations, there is the equity of the organization, which is the original equity plus the earnings, the retained earnings. Now we also have structure of the asset. The structure of the assets, you can compute for non-earning assets over total assets. So non-earning assets are assets that are not earning, right? So if you are a credit cooperative, in this case, a credit or a lending organization, then you immediately compute, okay, this asset is not earning. In fact, it's depreciating. You compute how many percentage of the total assets are not producing income. So it can also be computed as the cost of capital on the credit side, but on the asset side, it's how much of the asset are non-performing in a way, right? So percentage of investment, the degree of assets devoted to investment, yes, it can be just the percentage of investment over the total assets. Extent of assets financed by obligation, so the assets financed by external internal borrowing. So it's just the percentage of the asset, the percentage of the liabilities over the assets. External borrowings can be external borrowings from the banks. So instead of just external and internal borrowings. So sometimes you borrow from most of the times for organizations, they borrow from external origin, and that's the reason why we have external and internal borrowings here. Number 5.5, the extent of assets financed by member share capital. So this is really for cooperatives, the extent of assets financed by the share capital. So this is the participation of the member share to the total asset. So how many percent of the shareholders' equity is the asset? If you don't have obligation, then that's 100%. All right. So that's pretty much what we have at least for the first presentation, this introduction. Of course, we have example here from cooperative, but it's pretty much the same for financial institutions because cooperatives are sometimes credit cooperative, and that's also how it's being done with lending institutions, especially banks. Okay, so we have more of this next time. Thank you for listening and have a nice day. We'll have as part of this class the things that you need to do in order to understand this. So we'll have something that you need to do. Please take note of my instruction in the canvas. Thank you very much and keep safe, guys.